Hello, everyone, and thank you for joining us for another episode of the Financial Commute. I'm your host, Chris Galeski, joined by wealth planner Brian Standing. Brian, thank you for joining us.
As always.
I should also say that you are a practicing estate planning attorney as well, outside of Morton Walls.
Yeah, we try not to talk about that.
But that's what we're here to talk about today. I mean, we're trying to talk about estate taxes, estate laws. So, I mean, I felt like it was relevant.
Okay, it's relevant. Attorneys just don't have the reputation, I guess.
Because you bill by the word, and so the documents get quite long.
Yeah, it's the page, actually. So it's like when you were in college and you try to like make the essay longer by changing it to Courier font, and the professor's like, "What the heck is this?" I never did that.
I love how you brought in the font. All joking aside, it's an election year, in case you didn't know, but there are some estate tax laws that are set to sunset in the next year and a half. And so that's why we're here to talk about estate taxes or estate rules, estate strategies. This is sort of a follow-up from our previous episode.
Yeah, it's getting busy, although maybe from a topical standpoint, after the recent debate, we don't have to get political here. I think people are maybe a little less worried about the estate tax laws. I think it's still relevant because, as we talked about in the last episode, we've got a current exemption amount, right, which is an amount you can give away or pass away owning without estate taxes. It's above $13 million. That's pretty nice per person. The law is scheduled, as we talked about, to sort of revert back, call it $7 million in 2026. And it's possible, obviously, that could be extended, but sort of the default law, the way it's built in, is that it will revert back unless a new law is passed or a new budget is passed with estate tax laws in it. So after what happened recently, there's some sense of like, maybe we can wait it out till November, see if, parties change, see if they're going to extend the law. I would advise that people still be prepared for this because, as we'll get into today, estate tax planning, there's a lot of steps, there's some planning. You don't want to be scrambling at the end of the year.
And look, this is a follow-up from our last conversation in terms of who needs an estate plan. And the answer was pretty much everybody. If you don't have one, there's already one designed for you, and you may or may not like those rules. But now we're talking about who should do some additional estate tax planning.
Right.
And so right now, if your estate is you're married, your estate's north of $26 million, you should potentially raise your hand and say, maybe I should look into it potentially. Mm-hmm. If you're not married and it's just yourself, if your estate's north of $13 million, you might want to raise your hand and engage in a conversation. What are some other sort of key indicators that somebody should engage in having discussions right now around potentially some estate tax planning, knowing that these rules are set to sunset or get cut in half?
Yeah, so this will be actually a nice review to lead us into today because we went into detail, so I would encourage people to go back if they haven't heard that one. But it's not just about net worth, because whether someone needs to do estate tax planning is actually a more personal question even than just a sort of objective, like, what am I worth question. Yeah. You sort of have to meet certain requirements of, I have a lot of net worth. I'm leaving that net worth to individuals, right?
Not a charities,
right? In that case, you don't need estate tax planning. You obviously have to care about paying estate tax. And certainly some people say, you know what, it is what it is. My kids will be fine. Some people, as you know, will say, I don't want to pay any estate tax. I'd rather not do that.
And when you're saying that has to do with complexity. How complex you want to make your decisions in terms of setting up structures or different entities to try to avoid or reduce the estate.
Right, and then there's trade-offs. Even when you get to the bottom line of, I think I'm taxable, I'd like to reduce the tax burden upon my passing. Well, there's no such thing as a free lunch, right? Now we got to talk about the trade-offs of doing some strategies. What are you willing to give up as far as control, maybe income, other factors, before we even begin to determine, like, okay, here's a good plan for you.
Yeah. Now, I know you're not making blanket recommendations to the audience here, but typically if they're sitting there raising their hand saying, I'm worried that my estate is over this limit, I would like to reduce or, avoid paying estate tax and have more money go to my kids, there's typically a few different terms or phrases that those clients might come across, and we would like to educate them on what those are and who it might potentially be appropriate for. Let's start with the easiest one or most common one. typically used. I'm not saying it's a lazy way of doing estate tax planning, but it's an irrevocable life insurance trust or alternatively an ILIT. Let's talk a little bit about what that is and why someone would use that.
Yeah, so the context of that is estate tax, it's not like there's one perfect strategy, right? There's different things that you do to both potentially reduce the tax burden, but also be prepared to pay any tax. And so sometimes what people will do is have life insurance or even purchase new life insurance. And the purpose is to have liquidity so that if a tax is due, if the law doesn't change, money comes in at your death. There's money to pay estate taxes, do other things in the estate, which is nice.
So if I own a bunch of real estate and I really want my kids and family members to continue to maintain and own that real estate, I might buy an insurance policy that would create some liquidity in order to pay estate taxes that might be owed, so that way they don't have to sell or liquidate a property, because you never know if it's a good time to, sell a particular...
Yeah, you don't want to be forced.
You don't want to be
to sell, because estate tax, there are some exceptions as far as businesses and the time you can pay estate taxes, but in general, you have 9 months to write a big check. And so you don't want to be sort of fire selling properties to pay tax. So that kind of brings us to the ILIT, which is if I want 10 million of insurance available to pay tax, well, I don't want to end up with 6 million because the insurance itself is subject to a 40% estate tax. You wouldn't pay premiums to get 10 million of insurance to net 6. Right. And so there's a strategy where you wouldn't own that policy, because if you own it, that's what brings it, even though you never had the 10 million, right? The fact that you own it, you have the right to decide who gets it. The IRS says
policy is in your name.
You're taxed on the 10. Right. So you would, there's different options, but for the purpose of this conversation, you would want this life insurance trust to be the one buying this policy, for example, and you don't own it. What happens is, in order to purchase that policy and maybe to make premiums going forward, you're actually gifting to this trust. And it's a silly game we play where you're not the trustee of the trust. You gift money that's about the amount of the premium, and the trustee takes it and goes, thanks. Let me see what I want to do with this. And then after 30 days, they go, you know what? I think I'm going to pay this premium. We all know what we're doing, but as long as we play the game, there's notices that go out. We don't have to get into that detail. Then now the trust is paying for the premium. And so that separates you enough so that there's not sort of taxation on the 10 million in my example.
Yeah, thank you for that summary. It is a game that you sort of have to play in terms of making sure that you don't have control or access in order for it to be shown that it's outside of your estate. Let's say someone's like, okay, yes or no to the Irrevocable Life Insurance Trust. What are some other types of terms or phrases that they might hear when they're engaging in a conversation with you or another estate planning attorney around saving estate taxes? There's something called a SLAT.
Yeah, so that's becoming more common, sort of out of necessity. And the reason for that is that typically, conceptually speaking, when you give something away, you give away its income, its benefits, right? And so if you've got a sort of an estate tax cliff where you feel like, well, it's use it or lose it, right? If the exemption goes from 14 million to 7, I'm going to lose 7 million of available money to give to my heirs. Well, I'm going to give it away.
Well, estate tax free given to you.
Right. And so you say, okay, well, let's throw 14 million in a trust for your kids. Well, you don't get the income anymore, right? So you might be living off of that. You may want to live off of that in the future. You certainly aren't going to want to ask your kids to help you out financially. Yeah. And so...
So on that, right? Yeah. I mean, when you're engaging down this conversation, you've got to do the financial planning to know that you can give away this asset and still have enough assets and income to maintain the rest of your life. Because once you make this gift, it's no longer yours.
Right.
You lose not only access to the assets, but also the income that may generate. So, for example, a multifamily property, I own the asset, I'm living off of the rents. If I gave that asset away to somebody else, I no longer get to keep the rent.
Yes, exactly right. And there's some things that can be done. There's fees that can be paid for management. There's partial sales where you get, these are all things that you can chip away at some of that, but it's easier just initially to consider, okay, I give away the asset, I give away all the economic benefits. And so it's you coming back to the SLAT, you think, well, wait a minute, that's a big commitment. And so what the SLAT allows you to do, if you have a spouse, is to give assets to your spouse, right? And so you still are following the law such that you're giving away the income. It's not yours, it's your spouse's. So you might want to stay on good terms with him or her at that point, right? Because they're getting the money. And if they decide you guys get to go on a vacation that year, great. I joke, but it's serious because that is one of the risks of this strategy, right?
Because if they were to get, divorced or something were to happen to them, those assets don't come back to you.
Correct, right? Those are gifted assets that are in a trust for them, and then you split the rest, let's say. So there's some risk there, but the goal of this is to say, I'm giving things away. I'm maintaining indirect access to my monies, right? Because if we need them, my spouse can take them out. We can use them for something to benefit us. Obviously, we want to be careful and follow the rules, but this is why you end up doing these SLATs, which is we have to do something. We need to use the exemption, right? We're taking 10 million, 14 million, whatever it is. We're putting it in this bucket, and we've removed it from our estate. You file a gift tax return, and you use that number before the law changes, and now it's in this bucket, and you want to live off of your other assets, and hopefully leave that one alone because it can grow and it's outside of your estate. Yeah. So that's why people are talking about it. Just to add a final point maybe on SLATs is that the IRS is really going to scrutinize sort of double SLATs, right? Let's say we're married. Mm-hmm. I give 14 million to you, you give 14 million to me. We just keep living our lives the same way.
Right.
It's like, what's going on here? You guys are playing games. And so I would encourage people who are truly high net worth and are going to take advantage of both exemptions to separate those transactions as much as possible, right? This year, I want to gift money to you, right? No strings attached. I'm going to set up a trust. I want you to have a trust. Next year, you say, I want to give money to you. Different assets, different provisions, different trustee, and they're totally different transactions. This is the way you want to do it if you're really trying to hit a home run with this strategy.
Thank you for bringing up those nuances. One other thing that people like to kind of bring up in terms of reducing, eliminating, or avoiding tax, but still wanting to maintain income, we don't need to get into the details of it, but they set up charitable remainder trusts, things where they put assets in there. They're giving it away to a charity, in the future, but they can maintain access to income during their lives. That's another strategy that somebody might engage in with you. So we don't need to go down that in detail, but family limited partnership comes up a lot as well. Why would somebody engage in a family limited partnership structure?
Yeah, I think so. Sort of the foundation of this, and then there's sort of things you can build on top of it, is the concept of discounting. And so when we've been talking about the exemption, we're talking about, call it 13.61 million. And so we've been saying if your estate is above, 27.2 million, well, it's more complicated than that. Because if you own assets that have some restriction on them, right, the ability to sell without a partner's consent, maybe you don't control it at all. It's just an income interest, right? You're not a sort of controlling partner. Then the value of that asset is discounted for estate tax or gift tax purposes. So a family limited partnership, an LLC, sometimes with voting and non-voting shares, what this allows you to do is separate out types of ownership of an entity. So you've got sort of, let's say, a limited partner that doesn't have voting rights. So basically you have an income interest and they can't control sort of what that partnership does. Well, if you owned 40% of that, no one's going to pay you 40% of the fair market value of the assets because they can't control it. It's non-liquid. It's hard to sell that to a third party. And so ultimately you can reduce down the value. And so this would be the purpose behind these LLCs or these FLPs, is to create interest in an estate that can be discounted and not sort of taxed at full fair market value. Once you do that, now you're in the situation where you can do other transactions. You can do gifting, you can do sales transactions, details we don't have to get into today, but that's sort of the kind of the baseline to do more powerful planning.
So if you're invested in a property with, several different members and you're a limited partner, and let's say that property, your value's worth $20 million, because you don't have voting, because you don't have control, and because you can't make a decision on, when and how much that gets sold for, somebody else making that decision. For estate tax gifting purposes, the value of that property might not be worth $20 million. It might be worth 14 or 15.
Yeah.
And so that's an example of a family limited partnership in terms of being able to reduce the value.
Exactly right. And just so people know, from an administrative standpoint on this kind of a transaction, you are sort of appraising the value of the business itself, sort of full fair market value. It might be real estate, it might be a business, who knows. And then you're getting sort of a discount valuation, an actual professional evaluation of what would someone purchase this partial interest for, or this limited interest. What's nice about the gift, doing it as a gift, is you put that on a gift tax return, and the IRS has 3 years to challenge your valuation, right? And it's not that they won't, but it's less likely because there's nothing at stake for them. There's no tax to pay necessarily. And so you sort of get to lock in that lower valuation, whereas in an estate, if you have the limited interest, so you still get a discount when you pass away, the dollars are on the table. And so I'd like to think it's always like fair, but in my experience, when there's dollars on the table and you throw a 30%, 35% discount down, the IRS says, well, no, this is a negotiating start. Yeah. How about 25? And then for every dollar, they get 40 cents. And so, I would encourage people to consider doing it, if they feel comfortable, through gifting. Do it now, lock it in. You've got future appreciation, so there's some benefits.
And by gifting, you're referring to using part of your estate exemption today or your annual gift limit as well to kind of take advantage of those opportunities.
Yeah. Sort of accelerate that now, and so if you feel comfortable.
So quick summary, right? In about a year and a half, these rules are subject to be reduced in terms of the estate tax rules. What would you advise somebody to do?
Well, get organized first, right? If you're going to go into a meeting, you're really going to want to know, what's the value of what I own? What are some limitations? So do things have debt on them, right? Because that's going to be a roadblock on certain kinds of planning. Where's my cash flow coming from? How much do I need? Maybe project out future needs to the extent possible. Obviously, it's uncertain. But without this information, it's going to be hard to know which assets make sense. Does planning make sense? Are there things that are important in the family that we're going to keep? Are there things that we probably don't want to keep? All of this comes up because of the trade-offs involved with giving something away versus keeping it, getting a step up in basis and selling it. So I would say get yourself organized, get your assets together, get your income, your financial planning, cash flow planning, which, by the way, high net worth clients sometimes don't do. They don't need cash flow planning. Yeah. The cash flow is fine. But we're not talking about, can you retire? We're talking about, can you give this away and still be okay? Yeah. So I would get all that organized and then sort of get in soon and think about starting this year on just kind of getting organized on the potential plan so that we have a whole year.
Brian, thank you so much. I know, this was a little bit longer of an episode, so hopefully it's more appropriate for the commutes that we have in LA. But, thank you so much for your time today. And I look forward to doing another episode with you in the future and building upon these last two conversations.
Okay. Sounds good. Thanks.